What is up, YouTube? I'm Ace Palomero, South Texas Realtor, proud son of the Rio Grande Valley, and the Pug Whisperer. Welcome to my channel. Today we're going to talk a little bit about the U.S. economy at large, the local economy here in the 956, and why real estate may not be for you. Let's get this rolling. Last week was the Jackson Hole Economic Symposium in Wyoming, and present were central bankers, policymakers, academics, and economists from all around the world in this symposium. And the Fed chair, Jerome Powell, gave his speech regarding inflation here in the U.S. and I guess the outlook and the Fed's plan for all this. I'm just gonna read a couple excerpts from his speech, and this was August 25. Okay, so we're here on the outlook. Getting inflation sustainably back to 2% is expected to require a period of below-trend economic growth as well as some softening in labor market conditions. So basically, unemployment is still not high enough. And here on the economic growth, we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer run trend, and recent readings on customer spending have been especially robust. But basically, we're still spending a lot as consumers. Regarding the labor market, job openings remain high, but are trending lower. Payroll growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This one sticks out to me. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for monetary policy response. Over here, he restates the Fed's goals. 2% is and will remain our inflation target. We are committing to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. So they're saying they're not going to just turn around and drop that Fed funds rate. So to, I guess, anybody saying the Fed's going to pivot and mortgage rates will come down because they're going to drop that Fed funds rate down, like, they're literally telling you they're not going to do it. And right here at the conclusion, we will keep at it until the job is done. So I want to go over a couple headlines and excerpts from these articles that have bearing on the U.S. economy as a whole. UPS, and this is from NPR.org, UPS workers approve 5-year contract capping contentious negotiations. Good for them. They won their higher pay, better scheduling, working conditions. This will likely increase the cost of shipping for companies, and companies are going to do what they do and pass as much of those increased costs along to us, the consumers. From AP News, Associated Press News, APnews.com. Job vacancies, quits plunge in July in stark sign of cooling trend in the U.S. labor market. Okay, number of job vacancies dropped to 8.8 million last month. So there's still plenty of jobs going unfilled, according to ZipRecruiter. So labor market still looks tight. Still from APnews.com. U.S. consumer confidence wanes with prices still high and signs of a cooling job market. Americans are feeling less confident financially as summer comes to a close, and high prices and interest rates weigh on their willingness to spend. Consumers' view of current conditions fell to 144.8 from 153. I guess it's an index of consumer confidence in the economy. The cost of everyday essential items also has consumers frustrated. The downturn in spending has showed up in the earnings reports of many high-profile retailers. So Target, Best Buy, Home Depot, looks like all of them are experiencing declines in their sales. It's from Yahoo Finance. New car market, prices are about to plummet due to oversupply. A recent report from UBS estimates that global car production will exceed sales by 6% this year, leaving an excess of 5 million vehicles that will require price cuts to get sold off of lots. From CNN Business, U.S. consumers' mood soured at the end of summer on inflation worries. Gas prices have risen in recent weeks, and student loan repayments resume in October, which could also weigh on U.S. consumers' moods. It's unclear whether the U.S. consumer's resilience will persist through the end of the year, though Fed economists said they no longer predict a 2023 recession. Investors expect consumer spending to slow the rest of the year but not fall off a cliff. We're on the labor market, but both the economy and job market remain on strong footing, and that's helping keep inflation elevated. So according to Reuters, the indicators of a recession include an inverted yield curve, plunging consumer confidence, weak industrial production, and slowing bank credit. Now, bank credit is already slowing. There's less mortgages being written. Credit is harder to come by because of the credit crunch. I wouldn't say consumer confidence is plunging, but it's definitely starting to curve down a bit. And we've had an inverted yield curve since October of last year. A little bit on Finance 101. For U.S. Treasury bonds, usually the one with a short-term maturation has a lower yield than one with a longer-term maturation. So a 10-year Treasury bill should have a higher yield than a 5-year or 2-year or 3-month. And when the yield curve inverts, it means some of these short-term maturations are higher or have higher yields than the longer-term maturation. So like the 2-year will have a higher yield than the 10-year. And according to usnews.com, an inverted yield curve has accurately foreshadowed all 10 recessions since 1955. And this is according to the data from the Federal Reserve Bank of San Francisco. And they've only had one false positive in the mid-1960s. Now I want to show you all this, I guess, as I'm recording. So as of right now, 8:53 p.m. Tuesday, August 29, 2023. For a U.S. 10-year Treasury note, the yield is 4.125, at least according to MarketWatch. And for a U.S. 2-year Treasury note, it's 4.909. So, yeah, 2-year has a higher yield than the 10-year. Let's talk about the Valley a little bit now. So this is from This is from the Texas A&M University, the Texas Real Estate Research Center. from August 21 this year. So the board summary: second quarter 2023, board employment went up to increased by 5,400 jobs. Unemployment rate went up to 5.3 by 10 basis points from previous quarter. Housing sales down 12.2% year over year, and net trade value is down 2.74 billion year over year. Now this is the McAllen Edinburg Mission MSA, the Brownsville Harlingen MSA, and El Paso and Laredo. Let's focus a little more on the McAllen Edinburg Mission MSA. So it looks like McAllen had a 2% growth for the business cycle indexes. McAllen Edinburg Mission's unemployment rate remained unchanged at 6.3. Regarding average hourly earnings, McAllen has remained mostly unchanged. Yeah, and then this is all data we've seen before. So 10% decrease year over year for housing sales. Median house price increased by 5.2%. This is from the Dallas Fed. This is from 2017. This is the BCG matrix. So I like this. Could probably move education a little more over here though. Yeah, with the addition of the medical school at UTRGV, A&M has a McAllen campus now. There was I'll throw it up on the screen, but I think they're trying to do like a distance learning for UT Austin's like law program. And I was hearing something about a PT program, but I'll see if I can throw that on the screen, and I'll put the links to both of those down in the description. But yeah, regarding education, I think Valley is expanding that specific industry, especially higher education. And tourism should be going up as well. I think it'll be going up. UTRGV has a hospitality management program now. Shout out, Dr. Singh. The growth in the Valley is just wild to me, and I'll throw in clips from when I was driving on this part of the video. But yeah, there's just so much development, especially the multifamily, even commercial properties. My last semester in the MBA program, the director of the Brownsville port came to speak to our strategic management class. And honestly, I forgot basically the specifics of what he said, but the gist of it was that the Valley still has so much more room for expansion, and especially the port of Brownsville is crazy underutilized. At least that's what I got from his presentation. One thing that I think that we're on tap in is manufacturing. So everyone's saying if bring manufacturing back to the U.S., hey, we're open here in the Valley. I mean, if Costco can get that sweet deal from the city of FAR or whatever municipality that any company can establish a manufacturing plant here in, like, I'm pretty sure they'll get a sweet deal from the city. I want to close out with just a little bit from this article from NerdWallet by Kevin Boyd. This is from 2021. So real estate versus stock, which is the better investment? And I'm just going to go over the pros and cons real quick. At least his pros and cons, the writers. So real estate. Where is it? Pros. Where is it? There we go. Investing in real estate is easy to understand. Investing with debt is safer with real estate. Real estate investments can serve as a hedge against inflation. There can be tax advantages to property ownership. Cons for real estate. Real estate investments can be more work than stocks. Real estate is expensive and highly illiquid. Real estate has high transaction costs. It's difficult to diversify your investments with real estate, and the return of your investment isn't a sure thing. Now with stocks. The pros. Stocks are highly liquid. It's easier to diversify your investment in stocks. There are fewer, if any, transaction fees with stocks. You can grow your investment in tax-advantaged retirement accounts. Now, the cons of stocks are stock prices are much more volatile than real estate. Selling stocks may result in a capital gains tax, and stocks can trigger emotional decision making. Real estate investing isn't for everybody, as you can, tell for yourself just comparing the pros and cons of stocks versus real estate. I think to invest in real estate, you need to be willing to wait for that payoff. You need to be willing to put in more work. Real estate is not the passive income that a lot of content creators make it out to be. You don't just, put your money in and expect payouts every single month. Like, it requires work. Things happen. You can have issues with tenants, issues with the building, insurance can go up, taxes can jump if property values jump. You may have issues with the management company that manages your properties. Yeah, real estate isn't like the passive investing or the passive income that it's made out to be. And before you get into any kind of investing at all, first of all, you got to make sure you have the disposable income to even get into that. You need to determine and none of this is financial advice. I'm not a financial advisor. This is just my opinion on these things. You need to make sure you have the disposable income. You need to determine your long-term financial goals, your long-term life goals. You need to determine what your risk tolerance is. Yeah, real estate investing is not for everybody. But if you are looking to invest in real estate, specifically here in the Rio Grande Valley, my information is below. That's it for today. Bye.